The South African consumers will know this afternoon whether they will be paying more or less on their debt. The South African Reserve Bank's Monetary Policy Committee will make its second announcement for the year on interest rates after keeping the landing rate unchanged in January. For more on this, let's now speak to Econometrix Director Dr. Azar Jammine. Dr. Jammine, a very good morning to you. Thank you so much for making time for us this morning. So, looking at some of the expectations, some analysts are saying it will remain unchanged at 7.5%, but there's also possibility of a 25 basis point cut, considering the CPI that we saw coming through yesterday that has remained unchanged. What do you forecast?
I forecast that the Reserve Bank will leave the repo rate unchanged at 7.5%. Yes, yesterday's CPI inflation outcome was better than expected. Most forecasters were looking for a figure to rise from 3.2% in January to 3.4% in February, but it remained at 3.2%. which is close to the lower end of the inflation target of 3 to 6%. Secondly, the rand has been quite strong of late, despite all the hoo-ha about relations with America. And that means that the portents are very positive for inflation to remain lower than would otherwise have been the case. Certainly, import costs are very subdued at the moment. Thirdly, the price of oil internationally has decreased by around 7 to 10% in the past month. That also provides scope for interest rates to come down. But having said that there is considerable scope, remember now the repo rate's 7.5%, inflation at 3.2%, you're talking about a real repo rate of 4.3%, which is really very high and suggests a tight monetary policy. But against that, one has to weigh the uncertainties created by the Trump administration in terms of its impact on financial markets and the fear that the tariffs on imports around the world that are being imposed by the United States will lead to an escalation of inflation. And we saw last night in particular, the US itself, the Federal Reserve Board, left its own interest rate unchanged. And the main reason they cited for that, the economy is weakening a bit. Yes, they're afraid that inflation could turn out to be higher in America than previously expected because of those tariffs. And it's that uncertainty that I think they set a marker for our own Reserve Bank to follow. And none other than Reserve Bank Governor Lesetja Kganyago has on occasion in the recent past mentioned the fear of higher inflation ending up from the import tariffs that are being imposed in America.
Yeah, and with the last MPC statement as well, they did mention the US, and also one of the points, though, that was raised in the 30th of January statement was that it is even possible that the US rates could go up and again to stabilize inflation. And then you look at the remarks by Jerome Powell yesterday as well. This is looking at the Fed in the United States, that the Trump policies are actually to blame for the high costs that we're currently seeing and the tariffs that you just spoke about. But what does that then mean for South Africa? Even though we have this the battle between South Africa as well as the United States, you say it's for at least in some sectors, it seems that the country is being cushioned. But what does the tariffs then do for the country and our inflation rate?
The higher import tariffs by the United States will not lift South Africa's inflation rate very much up because the proportion compared with the likes of Canada, Mexico, Brazil, Argentina, many South American countries, and even some Asian countries, the relative dependence of America for trade is much, much larger than is the case with South Africa. In our case, if European inflation were to rise strongly, and that's where the potential upward pressure from the US tariffs could come, is that if America imposes harsh tariffs on Europe, which it hasn't done yet, it has threatened, but it hasn't done yet, then, South Africa importing some goods from the Europe might import them at a slightly higher cost than was previously the case. And of course, China, the same thing. And that's not going anywhere fast. So I'm not afraid of the impact on our inflation rate of what happens in America. The bigger fear is that what does happen in America might indirectly influence the rand to weaken, and then that would put upward pressure on the currency. There's another factor that we need to take into account as to why the Reserve Bank may not lower interest rates today, and that is the uncertainty surrounding the budget. Are we going to get a 0.5% VAT increase or not? If we do, that could raise inflation by about 0.2% straight away. And of course, it carries through to next year. And more generally, if they don't raise VAT, then what does that mean for the budget deficit? Is it going to increase compared with already the revised budget deficit of GDP higher than the one presented on the 19th of February? So, and that, of course, calls forth the possibility that South Africa's public debt would rise by more than anticipated, and that can put downward pressure on the rand because ratings agencies would be less wanting to invest in the South African currency. We've also seen that long-term interest rates have risen quite a bit in the last few months, and the rumor or the story is that American investors have been pulling out of the South African bond market because of what's been happening between our relations. Now, that if that gathers momentum, of course, the rand could weaken quite a bit further. It's those uncertainties. Yep. Other things equal, though, inflation should be very subdued, and that does pave the way for some interest rate relief later in the year. But I think what Kganyago is going to do is copy the book set by Powell yesterday. What did Powell say? He said, growth is weakening, inflation could rise, we've left interest rates unchanged. Yep. It gives us time to decide at a later stage the way things are going. If the economy weakens a lot, then we can cut rates. And inflation, if it doesn't turn out to be that high, we can cut rates. If, however, inflation rises by more than we expect, then we can raise rates. For the moment, let's leave rates where they are, and then we can decide according to what the data say in due course. And I think that's exactly what Kganyago was going to say as well.
Just quickly, Doc, with administered prices, NERSA has announced a tariff increase of 12.74% for Eskom's direct customers. And then on top of that, also, we've now seen the return of load shedding, although not as difficult and as hard as we've seen in previous years. But what could that do to the decision that is being taken by the MPC today?
Yeah, I think on the load shedding front, I'm not particularly concerned. You can see already the stage 2 load shedding that was instituted over the weekend has already been abandoned. It's really had minimal impact. I think that Eskom is one success story over the last year. Operation Vulindlela has been very successful in bringing about an improvement. There's been a vast change in management of the company that is based on capacity and experience rather than on cadre deployment. And so I don't think we're going to see a huge increase in load shedding to affect the Eskom tariff hike was expected, or most models actually built in an increase of that order of magnitude between 12 and 15%. Remember, Eskom had requested 36%, and that was what's scaring people about inflation. The fact is, it hasn't come out that high. I know it's way above inflation, but compared with last year's increase, it's not that much higher. And so that in itself is not going to cause a big jump in inflation. What people were fearing, and that's what contributed to them expecting a higher outcome for inflation in February, were medical aid costs. But somehow the measure that was used in the CPI of over 6% was not at 11% that many had feared.
Okay.
So that too is an administered price that has not proved to be as scary as had been feared.
Okay.